consumer staple sectors actually performed quite well year to date relative to the market. And you see the relative valuations at roughly 20%. That's double what the historical average was. So investors have been hiding out in these names. And I think what happened with the recent news from Target and Walmart is it kind of put a little bit of a scare in those money managers, portfolio managers that flooded all that money into this space, thinking that there was going to be no earnings risk. But as we've been saying on the show and for the past few months, it's going to get pretty tough for these companies as we get deeper into the year, as pricing that they've announced may not make it to the market because of the margin pressure their retail customers are feeling. And I do think, just looking at some of the work that other RBC analysts have done, that we could have some more issues with inflation in the energy and agricultural side.
The bigger picture is we're starting to see the tip of the iceberg of a problem, and the problem is a recession. And I think that the market is still grappling whether that is a reality. And my experience has been that when you start to see some of these big bellwethers start to tip downward, and it's more about these big megatech companies, when you start to see them tip downward, you will see more of them. It's not going to be in the March quarter, obviously. We've seen that play out. It's about the June and September quarters. I think we'll see more of that. And one final thought is that ultimately is that these issues don't typically correct themselves within a quarter. Just as Netflix, they had that big step down and then a subsequent step down. And so to answer your question, how I feel about big cap tech right now, I'm really concerned about the substance of a recession. And some of these companies are still up measurably from where they were 2 years ago. And investors are going to use those as candidates to take risk off, I think, over the next few months. But if I may, just one more minute here, is that I don't want to bury the lead. I do think this is a cautious environment. I am optimistic that once this bar gets reset, 2023 is going to be a standout year for tech.
There's always a recession in your future. The question is it 3 months away or is it 3 years away? If you believe that we're going to see a recession between now and the middle of 2023, you don't want to be legging into this. If you believe, as I do, that it's going to take longer to kill the cycle that we think, that this is probably something more like early to mid 24, then history proves that these tend to be pretty good buying periods. It doesn't mean that everything is fine. All the bearish arguments that the consumer is strained and what we heard recently from some retailers, I mean, that's not fake news. We know that that's true. But if you don't have a recession, earnings continue to go up, and credit spreads and the VIX will come down, and that'll be good for stocks.
Where we're dipping our toe in are retail stocks that are trading at like 5 times earnings. They're trading below pre-COVID levels, where a recession scenario is already priced in. And what we've seen is in the past couple of days, even we've seen some of these companies report and even guide down for 2Q or guide down for the year. And the stocks are ripping because because the valuations are so low. Now we do have a lot of stocks that are ripping independent of any news, just because people are chasing the junk. But I think in these cases, like the fact these stocks are up on earnings that maybe even they were down in the pre-market, but they rally because how bad are earnings really going to be?